Look at the top-line data, and the U.S. economy appears to be an unstoppable force cutting through rough waters. GDP growth is robust, consumption is holding strong, unemployment remains near historic lows, suggesting a baseline of widespread financial stability. But look beneath the surface, and a very different picture emerges. This chart shows GDP growth on the left and consumer credit card defaults on the right. That line has completely eclipsed pre-pandemic norms, hitting its highest level since the Great Recession. This presents a strict contradiction. If the macroeconomy is thriving, why are household balance sheets failing at rates unseen in 15 years? Traditional metrics used to gauge national prosperity are masking a severe strain in consumer finance. They are failing to capture a rot happening at the individual level. To understand where this strain is coming from, we must isolate exactly who holds this debt. This chart breaks down 2025 credit card debt by generation. The average millennial balance climbs to $6,961, overtaking baby boomers. Meanwhile, Generation X shoots up to $9,600. Compound these with 22% interest rates, and interest charges turbocharge the debt. The banking industry has a working theory for why these accounts are failing. Lenders rely on credit scores to separate safe bets from risky ones. The hypothesis is that pandemic-era interventions distorted consumer risk profiles so severely that they broke the credit scoring system entirely. The stakes are high. If the bank's theory holds up, this spike in defaults is just a technical glitch, a localized failure of lending algorithms. If the theory is wrong, we are looking at a systemic collapse of the American consumer. In 2020, the federal government initiated a series of aggressive interventions to stabilize household finances. Lockdowns eliminated travel and dining out, acting as a forced savings mechanism. Direct stimulus checks boosted household incomes, while forbearance programs paused loan payments. The immediate result was an artificial elevation. Credit scores drifted steadily upward across the entire population, completely divorced from any actual increase in economic productivity or personal wealth. This chart illustrates credit score compression. Because the pandemic lifted high-risk borrower scores, the gap between the 20th and 50th percentile shrank from 117 to 107 points. Consequently, non-prime borrowers with scores below 660 fell significantly. Risky borrowers were mathematically erased. For lenders, this compression was highly dangerous. If a borrower who was historically close to missing a payment received enough stimulus money to avoid default, their credit score suddenly looked identical to someone who was never at risk to begin with. A highly compressed score distribution destroys the system's foundational purpose. When numbers cluster together, lenders lose the ability to rank the probability of default. To see exactly how credit card issuers reacted to this artificially elevated, highly compressed borrower pool, researchers at the Philadelphia Fed conducted an audit. This graph tracks the relative credit score of the median new card borrower. Did banks adjust their risk tolerance? After a brief defensive tightening in 2020, the downward trend aggressively resumed. By 2022, issuers returned to pre-pandemic behavior, approving borrowers further down the score distribution. The data is clear. Lenders largely ignored the artificial nature of the score inflation. They treated these newly minted higher credit scores as genuine indicators of low risk, and they kept lending. But did that trust in inflated scores actually cause the current wave of defaults? To prove or disprove the banking industry's theory, the Fed used a specific statistical metric known as the area under the curve, or AUC. Plotting defaults against safe loans measures model accuracy. Blind guessing yields a diagonal line, AUC 0.5. A flawless model forms a right angle, AUC 1.0. Historically, the industry operates along this Bode curve, AUC 0.88, successfully separating good risk from bad. If the pandemic successfully distorted the credit scoring system, we should see this historical curve collapse inward toward the blind guessing line. The math leaves no room for debate. This test will prove whether the current default crisis is the result of blind algorithms or if something worse is happening to the consumer. The researchers ran millions of credit files through the AUC test. Here is what they found. During the absolute peak of the pandemic freeze in 2020, predictive power weakened, dropping 1.3 percentage points as lockdowns made default behavior highly erratic. But it was temporary. By 2021, the curve snaps aggressively back to its pre-pandemic baseline. The models restabilized. Still, you might argue that the damage was done to new borrowers, people granted their very first credit cards during the distortion. So the Philadelphia Fed isolated that exact group. This chart tracks the informativeness of credit scores exclusively for first-time cardholders. The predictive power never dropped. In fact, starting in 2019, the average AUC for this group rose to a new higher level, holding firmly above 0.814. The industry hypothesis failed to materialize in the data. Credit scoring models successfully maintained their predictive power throughout the pandemic, effectively identifying who was safe and who was going to fail. This forces us into a very uncomfortable corner. If the risk models worked perfectly, how do we explain the massive, ongoing surge in credit card delinquencies? Credit scores are designed to rank borrowers against each other, but they cannot account for a systemic decline that impacts the entire population simultaneously. As the government stimulus evaporated, households collided with volatile prices for daily expenses. The math of daily survival became drastically more expensive. To bridge the gap, people turned to their credit cards just to buy food and keep the lights on, and waiting for them with those record-high 22% annual percentage rates, rapidly converting short-term lifelines into long-term liabilities. The banks didn't lend blindly. They knew exactly who the riskiest borrowers were. The problem is that the entire pool of consumers is sinking